In Chapter 4 and 5, we have studied the concept and calculations of time value of money. So now we're going to apply those in Chapter 7 and try to understand the valuation of bonds. In this chapter, we will try to understand bonds, what is a bond, and what are the features of a bond, and also who issue bonds. We'll try to calculate bond prices for different kinds of bonds, and then we'll try to understand the relationship between bond price and interest rates. We'll also try to understand the yield and calculate the yield for a bond. Then we'll try to understand the concept of risks in bond investment, including the credit risk and the use of bond ratings. Before we start, I have a link here, and go to this video from Khan Academy. It's a very good introduction of bonds and bond financing. So I would highly recommend you pause here, go to that website and watch that video. It's not a very long video, so watch it and then come back, and then we'll talk about the bond overview. When we talk about financial market, maybe you will think of the stock market. But the fact is, the bond market is actually way larger than the stock market. It is actually the largest security market in the world. So investors, if you want to invest in bonds, you have a lot of options. As you will see later, we can invest in different kind of bonds issued by different issuers, and bonds with different maturities, and also bonds with different features. So a bond is essentially a loan. When an institution or organization issues a bond, they are trying to borrow money or getting a loan. And if you are buying some bonds, so you're one of the bond investors, then you are lending money to whoever issued the bond, I would say the bond issuers. So between the bond investors and the bond issuers, the relationship is a credit or debt relationship. So a lot of organizations or institutions issue bonds. That would include governments, corporations, and also municipal governments and government agencies. So whoever issues a bond, we will call them the issuers. So again, bonds are debt obligations. If they issue bonds, they are making a promise to pay back principal plus interest. You can imagine if the issuers fail to repay, they can face legal consequences. Sometimes that can drive them into bankruptcy. Bonds are also known as fixed income securities. If some organization issues a bond, in the bond contract, they will specify how much interest they're going to pay, so that investors, before they buy the bond, they know how much they can receive from the issuers, and also when they are going to issue the payment. I also want to point out that when we say they are fixed income securities, we do not mean that the bonds are fixed price securities. So the prices for bonds are not fixed. So if we try to buy a bond, what do we need to know about this bond? We are looking at some key terms about a bond. We'll start with the par value. So the par value is actually the face amount of a bond. It's also the amount that the bond issuers promise to pay at maturity, or say when the bond matures. So let's just say Southwest Airlines issued a bond back in 1997. That's a long time ago. And we have the issue date. That's when the bond was issued. So back in end of February of 1997, they issued the bond. And the bond is going to mature by March 1st of 2027. That's the maturity date. So this is a 30-year bond. The bond had a maturity of 30 years in total. So think of the maturity date as the day of death for this bond after March 1st of 2027, this bond will not exist. This also means by March 1st of 2027, Southwest Airlines actually will pay $1,000 face value, or say the par value, or the principal payment, whatever you want to call it, per bond to the bondholders. So usually the par value is assumed as 1,000 per bond. That's just a custom. So again, that's the amount that this company will pay investors back at maturity. So think about this is the last lump sum payment to the bondholders. The next concept is the coupon interest rate. So as you see, for this bond issued by Southwest, the coupon rate is 7.375%. That is a stated interest rate paid by Southwest, the issuer. So what you want to do is to use the par value, $1,000, multiplied by 7.375%. You would get $73.75. That will be the so-called coupon payment for the whole year. So dollar payment of the interest, or say the coupon payment every year, is determined by the par value multiplied by the coupon interest rate. Based on how much you had to pay to buy this bond, how long this bond has till maturity, and how much the bond pays as coupon interest payments, we can calculate the return for the investors. We'll talk about this later, but at this point, let me just say this return is called yield to maturity. It helps us to understand the rate of return in these investments. And again, we'll talk about the calculation later. So all those bonds in the bond market, where are they coming from? Also, who issued them? If we look at bonds by different issuers, we have government bonds, corporate bonds, and also the municipal bonds. So let's first look at the government bonds. In US, we have the US Treasury bonds. Treasury bonds, they are issued by the United States Department of Treasury. When the Department of Treasury issue these Treasury bonds, they are borrowing money for the US federal government. If you buy the US Treasury bonds, you are lending money to the federal government. There are 4 types of the Treasury securities. The first 3 here, they differ by maturity. If you look at the Treasury bills, or say the T-bills, they are the very short-term Treasury bonds. And because they are so short-term, usually like 3 months or 6 months, they do not pay coupon payments. And then you have Treasury notes, or T-notes. Those are the bonds that have maturity between 1 year to 10 years. And then we have the very long-term T-bonds. They are the bonds that have the longest maturity. So if we are looking at a 30-year Treasury bonds, so they are the T-bonds. Those bonds, they would pay coupon payment every 6 months. So again, T-bills, T-notes, T-bonds, they are all issued by the same organization, the Department of Treasury, on behalf of the U.S. federal government. The difference is in the maturity of those bonds. And then we have the TIPS, which is the Treasury Inflation Protected Security. So they are also issued by the Department of Treasury. The difference between the TIPS and the other kind of Treasury bonds is that TIPS payments are designed in a way they can help to protect the investors, or say the bondholders, a little bit from inflation. In the next couple of slides, we'll talk about how TIPS payments can achieve that goal, or say help to achieve that goal. But at this point, just remember TIPS is also a kind of Treasury security, or say Treasury bond issued by the U.S. Department of Treasury. These Treasury bonds, since they are issued by the Department of Treasury and backed up by the full faith and credit of the U.S. federal government, and we don't think the US federal government is going to go bankrupt anytime soon. So the treasury bonds, the US treasury bonds are considered the safest investment, not just in the United States, but all over the world. Other than the federal government, if we look at the municipal government, such as state government, city government, they can also issue bonds. If they want to build a highway, build an airport, build schools, they can try to issue bonds and raise money to fund those projects. Now, some projects can make money. So, for example, if you build a highway, you can charge tolls. You can use the revenue from those toll roads to help repay the bond. However, some projects you can't really expect to make money from them. So, for example, if Wichita Falls ISD wants to issue bonds and use the money to build learning center, you can't really expect that learning center can help make a lot of money. The bond will be paid back through tax revenues. At the end of this chapter, we will look at some details about the tax feature about the muni bonds. Basically, if you receive interest from those municipal bonds, the interests are tax-free, which give these muni bonds a little bit tax advantage. So we'll talk about that later. And then, other than the federal government and municipal government, we have corporations. So corporations can also issue bonds, and when corporations issue bonds, those bonds are called corporate bonds. So remember, we were just looking at a bond issued by Southwest Airlines. So that's a typical corporate bond. There are other issuers who try to use bonds to raise money. For example, we are looking at different government agencies, such as Fannie Mae, Freddie Mac can use the money to help homeowners. Sallie Mae, that's for student loans. And Small Business Administration can use the money to provide low-cost financing for small businesses. The last one we want to mention here is a mortgage-backed security. Those are bonds issued by, for example, banks who package all the mortgage that they have issued all together and sell them as bond in the market to other investors. So that's actually nowadays a pretty big part of the bond market. Now let's talk about the TIPS, Treasury Inflation Protected Securities. The TIPS were first issued in 1997, and the idea is to protect the investors against inflation. So think about this. If there is a bond that promises to pay $50 each every year as the coupon payment, and this is a long-term bond, so we're talking about maybe 30 years. The first year investors receive $50, that seems to be a lot of money. And then 10 years later, investors would receive the same $50 as interest payment, but that $50 would not be the same as the $50 at the beginning because of inflation, which lowers the purchase power of the same $50. So to protect investors from inflation, the TIPS principal is indexed to the Consumer Price Index. Consumer Price Index is commonly used to measure inflation. You may remember CPI from your introduction to the macroeconomics classes. If CPI rises, the TIPS principal will also be adjusted upward because the principal is indexed to the CPI level. And of course, if there is deflation, not say CPI index falls, then the principal will be adjusted downward. The coupon rate from the TIPS bond usually is constant or say fixed. But since the principal is adjusted by the CPI or say by inflation, and if you recall, the interest payment amount is the par value multiplied by the coupon interest rate, then the interest will also be adjusted, and it will be a little bit higher than before. So let's take a look at this example. we have this 2.75% tips. That means the coupon interest rate from this bond is 2.75%. When this bond was issued, at that time the CPI was 185.4, so we would call that the original reference CPI. And then current CPI now is 210.7, which as you see is higher than 185.4. So CPI level has been up. What is the current interest payment and the par value of the tips? So recall from the last slide, we mentioned that the par value of the tips will be indexed to the CPI level. So we look at the original CPI and we look at the CPI as of now. So 210.7 divided by 185.4, this is how much the CPI level has been going up. So it's about 1.136 times. And we use that number multiplied by the original par value, and then we get 1,136. So that is the new par value according to the current CPI comparing to the original reference CPI. Now, once you see the par value is adjusted, then this new adjusted par value multiplied by the coupon rate 2.75% would give you the interest payment from this tips bond for the whole year. And then you see that we try to multiply by half, or say divide this thing by 2. This is because usually the tips will pay coupon interest payment twice a year. Then each payment will be half of this much, and that will give you $15.63. So to summarize, to calculate the tips par value and interest payments, we'll compare the current CPI and the original reference CPI to see how much the par value is adjusted. And then we will use the newly adjusted par value multiplied by the coupon interest rate to calculate the interest payment for the whole year. And then we divide it by 2 to calculate the interest payment every time, or say every 6 months. Another thing about understanding bonds is to read the bond quotes. So when we look at those quotes from the market, one important thing to be aware of is that all these quotes are not about dollar amount. They are actually about a percentage. So for example, if you look at this corporate bond, this is the company that makes beer, right? And its last price is 91.47. This does not mean the company's bond was traded at $91.40. Instead, it's 91.47% of the par value. How much is the par value? Usually $1,000. So for this bond that has a $1,000 par value, the price is actually 91.47% multiplied by 1,000. That's how you get a price of $914.70. Same thing with the municipal bond. Here you have this bond issued by some office in New York City government. Price is quoted as 97.57. So that is 97.57% of the par. Now for municipal bonds, usually they have a par value of $5,000. So we use the 97.57 multiplied by the 5,000 par value to get the price for this one bond. It would be $4,878.50. By now, you may ask, okay, for your exam, what par value should you use? Unless I tell you otherwise, use the par value as $1,000. So by default, the par value of any bond should be $1,000. There might be some bonds, for example, the muni bonds, some treasury bonds, their par value is different. When that happens, for your exam, I will let you know in the question specifically what you need to use as par value. But if I do not tell you otherwise, then by default, the par value will be $1,000. You may have noticed that for the treasury bonds in the table in the last slides, there are bid and ask prices. By the way, we'll also see them in the next chapter when we talk about stock prices. So the bid and ask prices are from the perspective of the dealer. For example, in this case, if you want to buy this treasury bonds, if you want to buy, you're buying from the dealer. The dealer is asking for 104.22, almost 23. This stands for the price that the dealer wants to charge you when they try to sell you this bond. Now, if you want to sell the bonds that you currently have in the market, the dealer now is bidding for 104.21, 21.88. So that's the price they want to pay you. And so if you want to sell the bonds to the dealer, you will receive this price. The dealers, they will try to buy at a lower price here, and they will try to sell at a higher price here. I mean, you see the difference between these two numbers, two prices. That's called the bid-ask spread. And you can imagine by buying low and selling high, the bidders, they can make a profit. Again, if you want to buy, you will pay for the ask price. And if you want to sell, you will receive the bid price.